Warning signs before a fraud occurs. Before we start warning signs of fraud, we need to know what fraud is. Wrongful or criminal deception intended to result in financial or personal gain. There are many early warning signs of fraud which could alert senior/junior management and regulator. These all signs are very common in organizations. We could say red flag signs. It means that management should take care of that specific department or person. Fraud occurs with a triangle of motivation, opportunity, and rationalization. Weak internal audit control systems are a major sign of fraud. If the internal control system is weak and presents a lot of gray dots, employees could use that gray spot for frauds, i.e. falsify timesheets for a higher amount of salary, stealing of petty cash, supplies, duplicate invoices for supplies, forge signatures of directors, increasing vendor invoices through collusion, recording for fictitious transactions on the books to cover up theft. The auditor's reports to management showing red flags must be taken seriously. We need to keep in mind that audit teams, external/internal, are not there to find fraud, rather to ensure that the correct processes are in place as per company SOPs that will deliver proper fortification. Weak internal controls such as poor separation of duties, lack of supervision and poor documentation process give rise to opportunities for fraud. Allocation of authority not cleared is another sign. Delegation of authority and job description of each employee is very important for a fraud-free environment. If the job description is not clear, could be the cause of fraud. An employee can easily use any data or assets for financial or personal gain and easily delete, dump past records or destroy. The management should take care with the HR team to create a job description of each employee and approve it from the board. Every employee must know his or her responsibility and chain of command. Weak accountability and transparency system. Accountability means answerable for their actions and decisions when targets, tasks, and commitments are not met. A transparency means a duty to act noticeable, predictably and understandably to promote participation and accountability. Every organization has a record of punishment and rewards history. If the employees knew that punishment history of fraud is lean and standard setting, investigation, answerability and sanctions are not in place, the employee may take the opportunity. Behavioral irregularity is a red flag for fraud occurring or occurring near fast. Blaming other departments for interfering or showing aggression when specific questions are asked about figures, progress, and deficit or budgeted and actual cost. Erratic, irregular, changeable, unreliable, and incomplete reporting also sign that something is wrong. When false and exaggerated reporting, it's early warning of fraud. Management should be vigilant regarding incomplete reports from employees. Cross-references check of data that are missing or wrong is very important with other departments. Self-justification for committing fraud is very common and unpredictable. Changing position, location, or misbehave could be a good reason for fraud. Famous answers in these circumstances are, "They treated me wrong, there is no other solution to cover my expenses," etc. Motivation or incentive called demand or pressure refers to an employee's mindset towards committing fraud. Fact E, a sale transaction for achieving bonus, meet sales target regular. Showing low sale in sole proprietors for low tax payment to the government and less payment to employees. In many cases, directors and owners show more sales from company actual targets for goodwill, bounces, increments. Increasing share debentures prices in the stock market or for any other ultimate hidden ambition. Overstated mindset of employee or owners towards sales targets, very low, very high, expenses, very low, very high, drawing and loans are a mark of fraud warning. In wrapping up, fraud needs an environment. Without environment, fraud could not take place. Or someone cannot consider or attempt to commit fraud. Owners, directors, and regular employees always plan before fraud. When they did all the homework for fraud, then they tried. Before committing fraud, they take care of every single step. That's why you will notice that frauds happen in a very complicated and justifiable way. Fraudsters are always very keen to take advantage of opportunities, motivation, incentive, and rationalization provided by the owner, management, and regulatory authorities. And as a result, the owners, directors, and regular employees use gray areas and create reasons for fraud. Supervisory bodies could take care of each and every single fraud activity by setting standards. Any changes or abnormal and odd activities like inventory shrinkage, multiples payments, duplicate payments, over-invoicing, frequent complaints, employee lifestyle changes, missing documents, spikes in invoices volume, history of debts, excessive number of adjusting entries, after-hours setting in office without any special or emergency task, missing documents, excessive gambling, using mail drop address, excessive void and return check, etc. are all warning signs of fraud.